US employment data has been released today. One release has not met expectations and the other has exceeded them. Hi there, I'm Ben Jones, and joining me on the line to discuss this data is Joseph Lake from the Economist Intelligence Unit. Joseph, I'd like to begin by discussing the non-farm employment change. Figures are better than last month's disappointing 74,000, this time reaching 113,000. But it's still way below what most people estimated. What is your reaction to this figure, especially considering how many say it will have a strong impact on a potential March taper?
Right. Well, our immediate reaction is certainly one of disappointment. The US job market has definitely started the year with a bit of a whimper rather than a bang. Payroll growth has now been lackluster for the past 2 months, and for us it's really raised concerns that the economic recovery may be faltering. Now, there are a couple of caveats to that. The payroll data to begin with is very noisy, so it's got a very wide margin of error. So we find it's much better to look at the trend over several months in order to get a much more accurate picture of the health of the labour market. However, even when you do that and you look at the 3-month moving average for payrolls, it has slowed to around 154,000 a month, and that's a definite weakening from the average of the past 2 years, which was more around the level of 190,000, given the revisions this morning over the past couple of years and the re-benchmarking. So yes, we've definitely seen a softening in the labour market, and the question now really is how much of that is down to the awful weather that we've been having here in the US over the past couple of months, and how much is due to a loss of momentum in the economy. And I think if we look beyond the jobs numbers, there has been some good news for the US economy over the past while. Real GDP grew by 3.2% in the fourth quarter, and that was supported, crucially, by the fastest increase in consumer spending in 3 years. And that's really important for the U.S. economy because there's really nothing more important than the U.S. consumer. Private consumption accounts for about 70% of real GDP. So if consumers start spending money on that level, then that's really good for the broader economy. And the economic expansion in the second half of last year was the fastest that we've seen in a decade. So this supports our view that the recovery is broadening, and despite the slight softening in U.S. jobs data over the past couple of months, we think that the U.S. is embarking on an extended period of faster growth. And there are several reasons for that, and one of them is the large reduction in household debt over the past few years. And then again, of course, the continued low interest rates that have encouraged American consumers to open their wallets.
Now, moving on to the US unemployment rate, it's dropped further to 6.6%. Now, both the UK and the US have hinted at rate targets that may influence future policy decisions. So what can we take from this figure, and how do you see it affecting the Fed going forward?
Right. So a lot of central banks around the world have been experimenting with forward guidance and different ways to try and loosen monetary policy without actually taking any actions, but trying to commit to future policy decisions. And one of the ways to do that, as you said, was this unemployment rate threshold. And I think the really key word there is that this was a threshold. It was not a trigger point. So even when the Fed announced in December that it was going to taper, it also said that it was going to leave the policy rate on hold, quote, well past, unquote, its previous 6.5% unemployment rate threshold. So I think at this stage, with the unemployment rate falling so rapidly, I think it's really become a bit of a meaningless figure, this threshold. And yeah, we don't think it's really of much use anymore. Now, the other concern here is that the weak payroll numbers over the past 2 months has really raised the question of whether the economy is strong enough to withstand the withdrawal of QE3. And it has led to some speculation this morning that the Fed may pause the taper at its next meeting. Previously, it had said there was going to be a measured reduction in bond purchases at each Fed policy meeting in 2014 if the economy continues to make progress. And so most people thought that this meant it would reduce its asset purchases by around $10 billion at each of the 8 FOMC meetings this year, and that QE3 will finish towards the end of the year. And the good news is that the Fed's going to receive 1 more month of payroll data before it has to make this decision, because the next FOMC meeting is in mid-March. So that would give it a much better idea of whether this recent softening in the labour market is related to bad weather, or if it is a more structural or significant loss of momentum in the wider economy. And for us, unless the February numbers again come in well under the average of 190,000 which we've had for the past 2 years, we don't think that the latest data will alter the Fed's view of the economy.
Thank you for talking to us today, Joseph. I'm afraid that's all we have time for. That is all from me this week, but tune into Dukascopy TV throughout all of next week for even more updates and exclusive interviews. Thanks for watching. Goodbye.